Hook and promise. Hey everyone, welcome back to the Capital Breakdown. Today we're tackling a question that might just change how you see one of the most popular investments out there, the S&P 500. Is your S&P 500 really just a bet on a handful of mega-cap stocks? If you've ever thought the S&P 500 was just one big balanced basket of America's biggest companies, think again. By the end of this video, you'll understand two very different ways the S&P 500 can be weighted: market cap weighting and equal weighting, and why those differences matter for your portfolio's risk, returns, and diversification. Let's dive in. The problem or confusion. Most people think investing in an S&P 500 fund means buying a little piece of 500 companies equally, like scooping out one handful of fruit from each tree in an orchard. But in reality, the way the fund is weighted means you might be getting more of some fruits and barely any of others. Imagine thinking you're eating a balanced fruit salad, but half your bowl is just apples, and the rest is a sprinkle of other fruits. This misunderstanding can sneakily concentrate your investment in just a few giant companies, and that's a risk many don't realize they're taking. The core concept explained. So what does weighting mean in an index like the S&P 500? Think about it as how much influence or weight each company has in the overall index. Market cap weighting means companies with bigger market values, the total worth of all their shares, get a bigger slice of the pie. It's like a pizza where bigger slices go to the biggest players. Equal weighting, on the other hand, gives every company the same slice, no matter their size, like dividing a pizza into 500 equal tiny slices. Both methods build the same basket of companies, but the way they're mixed is very different. Core concept explained continued. To break it down further, market cap weighting naturally puts more money into the biggest companies, say a large tech company or a huge retailer, because their stock price times number of shares is huge. Equal weighting treats each company like an equal teammate on a sports team, no matter if they're a star player or a rookie. This means smaller companies get more attention in equal-weighted indexes than they do in market cap-weighted ones. Each method has pros and cons, and understanding these can help you see what kind of exposure you really have. How it actually works. Behind the scenes, index funds and ETFs aim to replicate these weighting methods as closely as possible. Fund managers or algorithms buy shares in companies according to the index's rules, either by market cap size or equally. Investors put money into these funds through brokers or retirement accounts, which then flows to buy underlying stocks. Because trading to maintain equal weighting requires regular rebalancing, buying and selling shares to keep each company's weight equal, it often involves higher turnover and potentially higher fees than market cap. Weighted funds. Regulators oversee these processes to make sure things stay transparent and fair. How it actually works. Continued. In market cap-weighted funds, when a giant company's stock price climbs, its share in the index automatically grows, meaning the fund buys more of that stock. For equal-weight funds, the fund must periodically sell shares of companies that grew too big and buy more of the smaller ones to keep the balance. This rebalancing can help manage risk, but might also increase transaction costs and tax impacts for investors. Understanding these mechanics helps explain why two funds tracking the S&P 500 can behave very differently over time. Simple, concrete examples. Let's say Sarah invests $500 each month into a broad market cap-weighted S&P 500 fund. Over time, her dollars flow more into the largest companies, so her portfolio grows heavily dependent on those mega-cap stocks. Now, if one of those giants stumbles, her portfolio could feel the heat more intensely. Contrast that with Mike, who puts his $500 into an equal-weight S&P 500 fund. His money spreads evenly across all 500 companies, meaning he's betting less on the biggest names and more on the full spectrum of the market. He may experience less concentration risk, but might see different volatility patterns and fees due to regular rebalancing. Simple, concrete examples continued. On the emotional side, Sarah might feel more confident when her favorite mega tech company surges, but more vulnerable if it dips sharply. Mike, meanwhile, may find his portfolio less exciting on any single day, but more stable over the long haul. Both approaches have their rhythms and require patience. Remember, investing isn't about quick thrills, but steady progress. These examples show how the same S&P 500 label can hide very different experiences depending on the weighting method. Risks, traps, and common mistakes. A common trap is ignoring concentration risk. Market cap-weighted indexes can become top-heavy, too reliant on just a few companies that dominate the index. If those companies face a downturn, the whole index may take a bigger hit. Equal weighting reduces that concentration, but introduces more frequent trading, which can increase costs and taxable events. Another mistake is chasing past performance without understanding the underlying weighting method or ignoring your own risk tolerance. And remember, highly concentrated single stocks or leveraged bets come with much higher risk. They can swing wildly and aren't suitable for everyone's time horizon. Risks, traps, and common mistakes. Patience and diversification are your best friends here. Trying to time the market or jumping between weighting methods without a plan can lead to frustration. Also, don't overlook how fees and tax implications over time can erode returns, especially with equal weight funds that rebalance often. Keeping your goals, timeline, and risk comfort front and center helps avoid these traps. The Capital Breakdown always encourages you to think long-term and stay grounded, not chasing the excitement, but building steady, informed habits. How to think about this tool. When you think about market cap versus equal weight indexes, place them within your broader financial life. Before you invest, make sure your budgeting is solid and your emergency fund is in place. That's your financial foundation. For retirement or long-term goals, understanding how different index constructions affect risk and return can help you choose tools that align with your timeline. Neither weighting is inherently better. They just offer different ways to slice the market pie. Use them as part of a diversified approach that matches your unique situation, always balancing growth potential with risk management. How to think about this tool continued. It's also helpful to remember that these are just building blocks. You can mix and match strategies over time or combine index funds with bonds, real estate, or other assets depending on your goals. The key is to stay consistent and informed, not chasing trends or hype. The Capital Breakdown's mission is to help you see behind the curtain so you feel confident making decisions. No matter which weighting method or investment vehicle you choose, understanding these fundamentals puts you in the driver's seat of your financial journey. Recap and educational disclaimer. All right, let's recap the big takeaways. First, the S&P 500 can be weighted by market cap or equally, and that changes how your money is spread across companies. Second, market cap weighting leans heavily on the biggest companies, while equal weighting spreads risk but requires more active rebalancing. Third, both approaches come with their own risks, costs, and emotional experiences. Remember, this video is purely educational, not personalized financial advice. Always do your own research and consider speaking with a qualified professional before making investment decisions. Thanks for breaking down the markets with us here at the Capital Breakdown. See you in the next episode. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.